What's going on, everyone? Welcome to today's intro to price action analysis. My name is King Jerry B, and I'm honored to be here to provide some type of value for you all for the first cumulative educational series here for Rippy Global. So for this first class, we're going to be talking about an intro to price action analysis, right? There's going to be four key components that I'm going to want to talk about as far as breaking things down and building up as we go into the second session, which is going to be a intro to structure using Wyckoff's market cycle. And then we're going to talk about combining all of that with back testing and conceptualizing how we can model our risk to reward, right? So first things first, we're going to do an intro to Japanese candles. We're going to talk about candlesticks using the anatomy of those candles and how we can see those in real time within structure. And then we'll use that as a framework to go into breaks of structure, changes in character, as well as breaking down the lower time frame and the higher time frame concepts. Third, we'll dive into some smart money concepts like trends, liquidity, as well as premiums versus discounts, and then use that as a means to talk about the difference between smart money concepts as well as retail trading concepts. And I'll also make some time towards the end of the session if you all have any questions with regards to what we're talking about within today's key objectives. All right, so first things first, let's dive into our Japanese candlesticks. So there's going to be three main candles that I want to focus on today. There are many chart patterns that you all have probably heard of: evening stars, three white soldiers, harami patterns, bullish engulfings, things of that nature. But for today, I want you guys to kind of eliminate that frame of thought and just try to think from a clear perspective using just raw candlesticks, all right? So what three candles we're going to talk about today are the spinning top. We have our pin bar / hammer, and we have our Morobozu candlestick. Does anybody in the chat know what a spinning top is? Any ideas or any clues about how we can use these candles in real time, or what they tell us from a very basic general perspective? Any ideas? All right, we have crickets, so we can just go ahead and dive into the info here. So your spinning top candle is going to be our indecisive candle. Indecisive. I spelled that wrong. But our spinning top, nonetheless, is going to be our indecisive candle. This is where price action is going to be at a standstill and at equilibrium, where our buyers and sellers are trying to figure out which direction they're trying to go in next, right? So indecisive candles can forecast a reversal if used at a strong key area of supply or demand, or support and resistance. So indecisive, reversal. All right. Next up, we have our pin bar / hammer. In a nutshell, the pin bar or hammer is our directional candle. It tells us which direction that buyers or sellers are thinking about driving price, whether we're going to the upside or the downside. And this is all used from a very basic general perspective. We're going to use more concepts like breaks and structures, as well as our changing characters, to really dive into strong confirmations when we see these candles in real time. But nonetheless, this is going to be our directional candle. Signifies strength or liquidity sweep. And we'll get into that once we break down the anatomy of these candles next. And last but not least, we have our Morobozu candle. Our Morobozu candle is going to be a candlestick that has little to no upper or lower wick. In Japanese, Morobozu means shaved head. So whenever you see these candles, you want them to have virtually no lower wick, or a very small upper or lower wick. Now, whenever I see these candles, I like to use them as a means of confirming strong order blocks or supply and demand zones. So when you see these candles, these are where we may make a lot of money to the upside or the downside because they're signifying volume, right? These candles might come after you see a pin bar or after you see a spinning top. Now, if you get the close below or above, then that is a very popular confirmation for upside or downside momentum. All right, but nonetheless, the Moribozu candlestick is going to signify volume as well as imbalances, okay? And we'll get into that once we talk a bit about our trends. But first things first, let's talk about the anatomy of these candles. So first, we have our spinning top, which signifies indecision or some type of reversal if used at a strong key level of support, resistance, supply, or demand. We have our pin bar or hammer, which is our directional candlestick. These are often recognized as strength. It shows us strength within the body, right? So if price comes all the way down, wicks into some supply or demand zone, that in itself is a liquidity sweep, sweeping liquidity from the downside and getting prepared to kind of take off and move towards the upside, which is where we may see a Moribozu candle, which are those big green candles or red candles that signify strong volume to the upside or the downside. All right, now we can break down this psychology even further by just talking about the basic anatomy of the candlestick itself. So we have red candles, which signify downwards bearish price action. And we have green candles, which signify upwards price action. Okay. Now, the way these candles move are one and the same. However, bearish candles signify downwards movement. Green candles signify upwards movement. All right. So we have 4 parts of the candlestick that we want to be mindful of. We have the upper wick, which is often recognized as our manipulation or distribution. So within the upper wick, depending on the time frame that we're looking at, let's say we're looking at the weekly or the daily, smart money or the composite man, if we're using Wyckoff terminology, he's going to be accumulating orders within this upper wick before taking price down to create a low or to close the candlestick. All right, and we'll talk more in depth about that when we dive into market structure next week. But nonetheless, in a nutshell, we have our upper wick, which signifies distribution, where orders are getting prepared to drop down to make a lower low or to put in a lower wick. We have the body, which is our expansion. This is where price is expanding, right? Price is opening here at the top of the body for step 1. It pushes all the way up to create a high for step 2. All right. And in between step 1 and step 2, that's where the smart money or composite man, if you will, is accumulating orders before the next leg lower. Okay. And we'll dive into this liquidity concept or model next week. But nonetheless, the main thing that I want you all to grasp here is this upper wick is a consolidation zone before the next move lower, right? But within the general anatomy of the candle, we know that the open is the initial part where the candlestick starts. For the bearish candles, price pushes up to create a high. After that, price gets exhausted and gets pushed all the way back down for our expansive move to create that low for step 3, and then comes right back up to close for step 4. Right, so price action looks like this whenever we're looking at a bearish candle. Price opens, pushes up to create a high. We have some orders being distributed within this range up here. Price gets driven all the way back down from the open to create a low. And then buyers step back in at some support or some demand zone to close price action. Now, before buyers step in to close price action, we want to be mindful of this lower wick, which is our accumulation. So the composite man is accumulating orders before expanding price to the upside. All right. Now let's do this same model for downwards price action to just go over the bullish momentum. All right, so we have our upper wick. We have our body, which represents expansive moves. Then we have our lower wick. For bullish candles, price action is going to open low, push down to create a low, push all the way up to create that high, and then come right back down to close. We want to catch moves when price is expanding or marking up or marking down when transitioning from distribution to accumulation. Okay, so here we have step 1 for the open. Price pushes down to create that low. Then we see it push all the way back up to create the high. And then bears are going to step in to close. The anatomy of the candlestick can range in various different forms, right? So we have our spinning top, which signifies indecision. So if the body, the upper wick and the lower wick are virtually the same size, as we can see here, then that's going to tell us that bearish pressure and bullish pressure are virtually one and the same, indicating equilibrium. So the confirmation that we need to look for is a close above or below the body to confirm if price wants to go to the downside or the upside. All right. We can also use our volume indicator to confirm that momentum, as well as our bias, depending if we're looking at the lower time frame or the higher time frame. Next up, we have my favorite, which is the hammer. As we can see here, the hammer, if we assume it's a green hammer, it's going to open low, push down to create a low, push all the way up to create a high, and it's going to close. So the high and the close are equal, which indicates very strong buying pressure within this range. Okay. That's why when we see the hammer, we get excited and say, okay, the hammer might confirm a reversal if it's at supply, or it might confirm an aggressive impulse move if it's at demand. Why? Because there's strong bullish pressure within the small body of that hammer if we're using it at a strong key level of support and resistance after a retracement or a retest of structure. All right, and we'll get more in depth with that structure part next week. So bear with me here. I'm just building up as we go along. But long story short, the main thing we want to know about our spinning top is that the upper wick signifies bearish pressure, the lower wick signifies buying pressure. If they're virtually the same, then price is at a standstill. And we're looking for either a close above or below to confirm that downside momentum or upside momentum if we're at supply or demand. Red spinning top signifies reversal at supply. Green spinning top signifies reversal at demand, and vice versa. Okay. Hammer or pin bar indicates very strong buying pressure or very strong selling pressure. Price action opens, pushes down to create that low, comes all the way back up to create the high, and it closes right there. So the high and the close are equal, indicating very strong bullish pressure. So if the next candlestick closes above, then that momentum might persist to the upside. On the contrary, we have our bearish candle, which is called a inverted hammer. These candles are best known for their accuracy at supply. So price action opens high, comes up to create a high, similar to our breakdown here. We have our upper wick distribution zone. Price action opens, comes up to create that high, pushes down to create the low and close, right? They're equal. So if the next candlestick closes under, then we could probably see momentum continue to the downside. Now there's a caveat to the hammer that I would like you all to be aware of, which is the pin bar. Now the pin bar has a slight lower wick or slight upper wick. Sometimes you might see price come up to break above or below the hammer, come all the way back down to some 50% mitigation of the lower wick, and then continue to the upside. This in itself is known as a fake out or a retracement back down to some imbalance on the lower time frame that probably was missed. This is a more advanced smart money concept that we'll dive into next week, but I just want you all to be aware that the hammer does not work every single time, right? There are inefficiencies that price may come back down to fill in before going back up. So that's why you might see a fake out when you see a hammer at supply or demand. So it's good to just be mindful of that sometimes you might want to mark off the 50% mitigation of the lower wick or the upper wick of the hammer before considering that trade. All right, next up we have our Morobozu candle. The Morobozu candlestick is my favorite because it tells me the effect of price. If I know that price action has fallen aggressively from some supply, you might see some really long red candles, right? Now, as we know, according to the efficient market hypothesis, the market is efficient. So what that means is whenever we see aggressive momentum pushing to the downside or the upside, smart money or smart money, order flow, or the composite man or whatnot, he's going to generate some type of liquidity. Maybe it's a chart pattern to retrace back into the left behind orders of the Morobozu before the next leg down. Okay, but the main thing here that I want you to understand when it comes to the Morobozu candles is that it leaves behind inefficiencies or fair value gaps that we can take advantage of to model our risk for a continuation to the downside or the upside if we have a break in structure or a change in character to confirm, right? Now let's dive into that next key component before, yeah, perfect segue. So now we're going to talk about structure, all right, using the Morobozu candle. So as we know, price action can be in a downtrend, uptrend, or sideways trend, okay? In this example here, we're talking about a quote unquote downtrend. So let's assume this first green candle before, series of red candles is our supply zone. But before that breakthrough supply, we see our Moribozu candle, okay? Moribozu, which is shaved off head. Now, this Moribozu candlestick is going to drive all the way down into some support. Let's just draw a box right here and call this support. And let's make this candlestick at the bottom a spinning top for the sake of today's explanation. A spinning top signifying indecision or weakness in the trend or reversal. If the next candlestick closes above that spinning top, then that is going to forecast, a reversal, but we need to know why price is reversing. Price may be reversing to come back to fill in some left behind inefficiency caused from that Moribozu. And we'll look at a real-time example shortly after this. But I want you to, grasp this. If price, let's say, breaks through supply at $100, comes all the way down to, let's say, $95, what institutions are going to do is try to buy low and sell high. So they're going to buy orders just so that they can fill in left behind orders from that Moribozu, just so that they can short price back down and put in another lower low. Okay, and what we can do is take this knowledge and say, okay, if I know there's an inefficiency left behind at $100 or at this Moribozu candlestick at some key level of supply, let's call this 4-hour supply. What we can do is wait for price to sweep liquidity from buy stop orders within this range, within this expansive range, tap in to this Moribozu order block, set our risk above supply, and our reward targeting the previous low for the next lower low, okay? Which brings me to the next key point, which is retail versus smart money. In this case, this is a smart money model or institutional model. Now, a lot of retail traders may see some chart pattern within this range, okay? Now, let's say we see a bullish pennant, right? Let's say we see a bullish pennant within this range. I'm gonna erase this so it can be a little bit clearer on our eyes. Let's say we see a bullish candle here, right? Price is accumulating. We got a bullish pennant forming. But there's still an imbalance up here. There's an imbalance caused by that Moribozu candle. So the volume or momentum is clearly coming to the downside, as indicated by the Moribozu candle itself. It left behind an imbalance or fair value gap. Price comes all the way down into our demand zone at $95, and we see a flag pattern forming. At this point, you could take this flag pattern, put your stop below target supply. That's a great play for scalps. Or you could put your stops at the same place and model it right back down for demand. Break and retest, either way it goes, you can make money. But let's know that this might be our 50% mark or halfway mark between supply and demand. What banks are going to do is drive price back up into this fair value gap, fill it in, and then drive prices lower. Why? Because we had a previous break in structure from the initial move down caused by those motorboats and candles. All right. So instead of trading, this pattern that could stop us out in both ways, we could be mindful of the most extreme supply. And remember, we're trying to buy low and sell high, right? So we can model our risk up here and have a greater risk to reward by looking for inefficiencies and modeling our we can look for inefficiencies and model our risk to reward based upon where the trend is going, right? So scalpers might take advantage of this breakout here for the upside or the downside. But if you're looking for a greater risk to reward to possibly swing into the next swing low, then I would wait for price to come back to the most extreme supply and then look for that momentum to persist. I know this was a lot so far. We've got one more topic to talk about, which is premium versus discount. So if you all have any questions or concerns, please feel free to type in the chat before I continue. But this is good. These are dojis, right? It's spinning top like hammer indecision. Is this recorded somewhere so I can view it later? Yes, sir. What's going on, Kicks We Trust? Where can I find that? Yes, I think they'll post it later. Okay, thanks. In the announcement, we'll be showing examples. Yeah, let's dive into some examples. But is everything that I'm saying clear so far? Thumbs up. Are you all alive or y'all still out there? Paying attention? Jordan Geary. Cool. Susan, what's going on, y'all? Welcome. How will the prices of options be reflected at the different zones? Perfect. So the price of the options are going to be dependent upon the Greeks and implied volatility, which is the next topic on our agenda, which is premium versus discount. Premium versus discount. All right. Does anyone here know what premium means? Any ideas? There are no wrong answers. Absolutely, value of the contract. Now, what about discount? The price you pay for the contract. Absolutely. So the whole concept of the stock market or whatnot is to buy low and sell high, right? So we want to buy low at a discount and sell high at a premium. Now, premium can also be synonymous with the general value of the contract itself. However, if we're looking at this just using price action, we want to look at premium within structure and how it kind of moves. So if we're looking at price in an uptrend, every time price comes down to touch some demand or to follow the order flow, that is going to be our discount. This is if we're bullish, of course. Now our premium is going to be up here. That's why it's really significant for us to understand where we are within structure, where the fair value gaps are, so that we can take advantage of the premium area within our models and the discounted areas within our models. Okay. So here at RG, we use a lot of limit orders and things. By no means are my scalping and signaling as good as the mods, Rippy or Reality, Aided, Jarvis, etc. But one thing that I've noticed is that whenever you have, let's say, a small account premium like 0.4, anything under 0.5, 0.4, if you want 100%, your goal is to try and sell for like 0.8, okay? Now, if that 0.4 contract comes out to be negative immediately, what we can do is say, okay, if I were to enter this trade using, supply and demand, buy low, sell high within price action, what does a 20% loss look like before I enter the trade? So what I personally would do if I'm looking to buy at a discount at supply or demand, depending on what I'm trading for the day, calls or puts, I'll premeditatively calculate, okay, if I usually get contracts for 40 to try and, get 50% return to turn it to 0.4 to 0.6 for 50%, then I'll take 20% of 0.4 and try to get a fill closer to 0.2, 0.32, 0.3. My goal is to buy at a discount. So if I just set my limits 0.32, 0.3, I'll automatically have accounted for that typical 20% downside price action, right? So whenever price does go in my favor, if it does go in my favor, then it will be easier for me to capitalize on a 50% return if it goes to 0.45, as opposed to me getting filled at 0.4. There's a major difference there, okay? And we can use our entry and exit models, we'll dive deeper into that next week, as a major framework to help us capitalize on big risk to rewards. Like for example, Jarvis got filled at 0.5 during the FOMC meeting for puts at a higher time frame supply. Those ran almost 900% to 4.5 because he targeted the most extreme supply. While Rippy traded both the upside momentum within the internal structure and caught the movement all the way down for both sides. The movement within the internal into supply from the 50% mitigation was only 100% to 200% return, okay? Whereas if we would have waited to just get a fill at 0.5, on a cheaper contract, the risk to reward is higher because that fair value gap had gotten filled prior to the move down. Okay, so if we, let's say, buy in at 1.0 here, and it goes to, let's say 2.0 here, calls will be in favor, right? Because that's a quick scalp. But as soon as price tapped into supply, this 2.0 would have turned into like 0.8 or like 1.6 very, very fast. Okay. So whenever we're modeling price action, we want to premeditatively be aware of what our premium would look like if we're trading calls or puts within the trend. I personally like to trade with the trend. So if, let's say, reality signals a play with at 0.5, I'm going to try to get it for cheaper at 0.32 or 0.3 and try to sell for 0.5. Does that make sense? And we can also see this within the internal structure and try to target our imbalances to give us a higher risk to reward or to kind of decrease our risk. Yeah, exactly. So with puts, you want to try to buy in at the most extreme supply. With the Rippey and Jarvis scenario, do you think you could break it down on TradingView? Yes, absolutely. All right, so yesterday, when was FOMC? This was FOMC. You don't let's put in, let's just use the 50 average so that we can kind of have a trend line of some sorts. All right. So with the Rippey and Jarvis example, you can clearly see here that there was some chart pattern, just like we had in our model. This is ugly, but y'all got the gist as we went through it. So this was our chart pattern going up into supply, right? Since we're on the 1 hour, actually, let's go to the 4 hour. We've got our 4 hour supply zone here. H4 supply, let's call this our premium. No discount since we're short bias. H4 supply. Discount. I'm excited to talk about liquidity next week. This is going to bring everything together. All right, so I went to the 4 hour and marked off supply. The first green candle before an aggressive impulse move to the downside. This candlestick is a Moribozu, bearish Moribozu. Okay. Within this bearish Moribozu, we have an expansive move to the downside with some inefficiency left behind. We can't see it on the 4 hour, but when we go down to the 1 hour or the 15 or 30 minute, it'll be a little bit more easier to discern and model. Okay. Now this lower wick on the 4 hour is our demand zone. I'm going to call this H4 demand. Premium. We can look to the left and see the first up candle before that aggressive push to the upside. This time we have a bullish Moribozu candlestick. Both of these candles have left behind inefficiencies. There's an inefficiency left behind here somewhere. There's an inefficiency left behind here somewhere. Okay. We have our infamous hammer. So what I'm going to do is mark off the body of this candlestick before that push higher. Or you could do the lower wick. Either one, it doesn't really matter. And I say that because we have confluence with the 50 moving average when marking off this 4-hour demand zone. I always want to look for confluence whenever marking off key S&D areas. Okay. And I'm also seeing some dojis here within the internal structure. So what I'm going to do is mark off this doji as equilibrium, which makes sense. 385 is the midway point between 390 and 380 key psychological levels. So I'm just going to mark that as support. And now when we go to the 1 hour and see what happened during our FOMC meeting, we had aggressive selling pressure at our supply zone the day before price gap down, right? Created a symmetrical triangle. You have liquidity above and below. So let's say reality called a swing, right? He probably would have gotten a risk reward of something like so, up into supply for the upside. And then let's say I called a swing for puts. I could have still made money, right? But my premium would have gotten chopped up. Why? Because price went up first before coming back down. Which brings me back to the point of understanding the most extreme supply and demand and using that as a means to model the most low risk plays. So we could have just marked off this supply and taken this trade to the downside. I actually caught this trade on QQQ in the morning here. But now what we can see is that this Moribozu candlestick, which is indicating volume, strong volume to the downside, has left behind a hidden supply zone or some inefficiency that price later came back to mitigate during the FOMC meeting. Why did price come back up here to mitigate this zone? Price came back up here to mitigate the zone because the current trend was bullish, as we can see here. The current trend was already bullish. So there was a lot of bullish buys because we were just respecting order flow. Buy low, tap into support. Buy low, tap into support again. We have our demand zone here. Price came in to fill in an imbalance, right? Tapped in with our hammer. I'll circle it. Price filled in some imbalance with our hammer. However, it didn't have enough momentum to push price to make a lower low. So we saw institutions engineer some liquidity to mitigate the leftover imbalances up here before coming back down. So if we go to the lower time frames for the Jarvis and Rippy example, we can see that the Rippy team called all three of these moves. The move to the upside and the move to the downside. Price came into demand, which was this support right here. We have our nice chart pattern. What is this called? A symmetrical triangle, if you will. Very high risk to reward, all the way up into supply. That was left behind. Jarvis, on the other hand, bought at a premium for puts and sold at a discount. No, bought at a discount for puts and sold at a premium. That's why his play went 900%. And Rippy's play went 200%. See, he was scalping. Jarvis was waiting for the reaction at some higher time frame supply to catch that move for a higher risk to reward to put in another swing low with the current higher time frame trend, which is obviously already bearish. But the great thing about this is we can trade the lower time frame within the higher time frame structure and to catch great risk to rewards, whether we're trading the upside or downside. It's all about understanding where you are within the internal structure and using market structure and price action as confirmation. Does this example help out? Did that make sense? Awesome. What is the FVG imbalance? FVG stands for fair value gap. Imbalance and FVG are synonymous. So when we're talking about fair value gaps and imbalances, well, me personally, since I analyze price, whenever I'm talking about fair value gaps and imbalances, I'm talking about these candles here, Moribozu's at supply and demand. So if we want to trade efficient price action, I'm going to do a downtrend since we're in a bear market. So if we want to trade efficient price action and use fair value gaps or imbalances as a means of modeling risk to reward, we can use this logic here. Let's say price is at 100. We get a nice break to the upside, change of character, retest, and then price comes back down. We know that price is going to go down to, let's say, $98. The aggressive markdown or impulse move to the downside, let's assume this is our Moribozu candle. there's going to be some inefficiency left behind. I'll make it green. Actually, no, let's make it blue because we have green and red candlesticks. We have some inefficiency that's left behind if we see an aggressive sell-off from supply after that initial green candle push to the upside. So we have our supply here. We've got our inefficiency left behind. We saw strong red candles after the rejection of 100. Now what we want to do is wait for price to retrace back into that supply to fill in that inefficiency before looking for discounted puts to put in the next swing low to 97 PT or 96 or whatever, okay? And as price is moving up to supply to fill in that inefficiency, it might be using green candles, which may also leave behind engineered liquidity or an inefficiency that may need to get filled in. And we see institutions do this all the time. They'll mark price up to 100, mark it back down to 98, push it back up to 99, mark it back down to 97. It happens all the time within structure. Or they might engineer some chart pattern to create liquidity to take out stop losses so that they can move the market however they want. But these are just some key tenets to be mindful of. During our next session, we will be talking about price cycles more advanced. So what we'll be doing is building upon the concepts that we learned today. We'll be analyzing the price cycles under the lens of Wyckoff's market structure, using consolidation, expansion, retracements, and reversals as a means of modeling our risk to rewards. Okay, we talked a bit about that using the Rippey and Jarvis example here. A little bit about the price cycles and how price will mark up and then mark down, taking out stops for both the upside and downside, as well as in our model that we just finished talking about here with institutions marking price from 100 to 98, back to 99, and then back to 97 to create that downwards trend, okay? But that is all I have for you all tonight. Thank you all for your undivided attention and coming out. Hopefully I was able to provide some value and gems for you all. If you all have any questions, feel free to let me know. I have 5 more minutes, so I can take maybe 2 more questions before we conclude the session. My pleasure, Jordan. Awesome, awesome. I'm so happy that you all were able to gain some value. What time frames do you plot your supply and demand? all of them. I look at everything in the charts, but my favorite time frames are the 1 hour and 4 hour. For scalping, let's say I'm busy at work, um, I'm going to use the 1 hour, 30 minute, and then take my entries on the 5 minute. We are very happy to help you grow, man. Thank you, V World, for supporting us. Any outside recommendations for additional details into these price structures and processes? Yes, sir. I will highly recommend a book by Annie Cool called Volume Price Analysis. Chapters 3 talks about market structure and patience. Chapter 5 and Chapter 7 are also great tools to use. I'll type it in the chat for you. Is SPY daily candle showing indecision or doji? No, sir, George. I do not assume. I allow price to come to me and I wait on confirmation, my change in character, breaking structure, and then I look for the inefficiency to retest structure before coming back down. And we'll dive more into what those entry and exit models look like next week. But to give you a quick sneak peek, this is my confirmation model for the upside. So essentially what I'm waiting for is for price to give me a breakout. I want retail to show interest in moving price up. I'll wait for some chart pattern to form, and then I'll find the most extreme demand zone and then model my entry from there. It takes a bit of time. I don't take trades every day, but I found this is the best way for me to trade with, preserving my mental day in and day out. But yeah, I wait patiently for price to come to my extreme demand after retail gives us a break in structure, and then for the chart pattern to be swept and then model it from there. But we'll dive into that next week. Awesome. Thank you all for your time. I'm going to go ahead and conclude the session here, and good luck trading. I hope you all have a blessed night. Take care.